When we talk about free cash flow, we need to take some relationships into account. So with our free cash flow, we have two types, nominal and real free cash flow. What do we mean by nominal? Nominal, it means that it reflects the market prices, the current prices, therefore it includes inflation. While real, it excludes the effect of inflation, because we know that inflation is misleading. Therefore, real will be usually more accurate. Therefore, every time we use a discount rate, if we have a nominal free cash flow, therefore we need to use a nominal rate, so we make it apple to apple. And if we have real free cash flow, we need to use a real discount rate. Therefore that we compare apples to apples. Remember that inflation rate in developed countries such as Australia, United States, UK, Germany, we have something called inflation targeting, which means we target the rate of inflation to be low, between 2 to 3%. But in developing countries, inflation rate is very high. Therefore, if you are making investment in any developing country, therefore you need to use real free cash flow and real discount rate. Don't use nominal, otherwise it will be misleading. But in developed countries, since we have a very low inflation rate, therefore we can use nominal free cash flow. Another relationship is, for our free cash flow to firm, we have two types, free cash flow to firm and free cash flow to equity. We know that the value or the price of any asset is the present value of all future cash flows. Therefore, if I'd like to get firm value, so this means that I need to get the present value of all free cash flow to firm. If I'd like to get equity value, this will be the free cash flow, the present value of free cash flow to equity. Therefore, we need to get a discount rate. Our discount rate for the firm will be weighted average cost of capital, WACC, because the firm reflects both debt and equity, while for equity, our discount rate will be only cost of equity, because we need to have a matching. We need to compare apples to apples. Another relationship is, when we talk about free cash flow to firm, we have two types, our pre-tax or before tax free cash flow to firm and post-tax or after-tax free cash flow to firm. Therefore, our discount rate, which is weighted average cost of capital, should match our free cash flow to firm. So if we have pre-tax or before tax free cash flow to firm, our WACC should be pre-tax or before tax WACC. If we have post-tax free cash flow to firm or after-tax free cash flow to firm, our WACC should be post-tax, because we need to compare apples to apples. Another relationship is free cash flow. So every time I use free cash flow, it means that I could refer to free cash flow to firm or free cash flow to equity. So we have here two types, free cash flow to firm and free cash flow to equity. So when we talk about the growth rate, if we refer to the free cash flow to firm, so we need to get the growth rate in our operating profit, which is earnings before instant tax. For equity, we need to get the growth rate in net income. So we need to compare apples to apples. We need to have matching here. When we talk about free cash flow, this free cash flow could be based on location or the currency of transaction. For example, let's assume that we have a company that operates in Mexico, but the currency of transaction is US dollar. Therefore, our discount rate should be based on the location, we use Mexican peso, or on the currency of transaction, which is American dollar. So usually we use the currency of transaction, regardless where it is located. Therefore, here we will have matching between free cash flow and discount rate based on currency of transaction. This will be more accurate.